Hello and welcome. You're watching Newsmaker and I am Ritu Singh. Now the big global story that we're tracking today, the International Monetary Fund sees global growth slipping from 3.4% last year and bottoming at 2.8% in 2023 in its baseline scenario amid increased uncertainty from recent financial sector turmoil. Now in its latest World Economic Outlook report, the IMF says growth could settle at 3% 5 years out, which is the lowest medium-term forecast in decades. The IMF also warns that uncertainty is high and a hard landing, especially for advanced economies, has become a much larger risk. It has also sharply cut India's growth forecast for FY24 to 5.9% and to 6.3% for FY25. Joining me now to discuss this report are Daniel Leigh, who heads the World Economic Studies Division at the IMF, and Nada Choueiri, who's IMF's Mission Chief to India. Daniel and Nada, both of you, thank you very much for your time here on CNBC-TV18. Daniel, I'll start with you because, a cut for the global growth, it is expected to bottom out at 2.8% and a 25% probability of this slipping to below 2% this year. That's a red flag. What do you attribute this fog over, global growth primarily to? And, what is the probability of us seeing a lower growth figure than you expected, a sort of outline in your baseline scenario?
Thank you, Ritu. We do see a slowdown to 2.8%, and that's really historically low. The global economy on average has grown by about almost 4% over the last few decades. And there is this increasing fog around the outlook, mainly because of the financial stress that we saw earlier this year. Also because we don't know how sticky inflation is going to be and how much central banks are maybe going to have to raise rates more. Our baseline, though, to be clear, is that the recent financial stress is contained, and policymakers have shown that they can separate the fight against inflation from then using tools as needed to sort of deal with the financial stresses. Now, probability of the growth is very much skewed downward. So that means that we could have growth below 2%, which has only happened 5 times in the last 50 years, of 25%. That's more than double the usual probability. And then something like a negative per capita GDP growth for the world, which usually happens in a recession, that's got about 1 in 6 chance right now. So this is a worrisome outlook.
Well, it definitely is, Daniel. Nada, let me bring you in as well, because there are sharp cuts for India's growth forecast, especially for the next financial year. And, even for this year, 5.9% is far lower than, Reserve Bank of India's own projection of 6.5%. Why the sharp cuts? Why the pessimism?
We have revised our growth projection for India for the current fiscal year. It was a slight revision from 6.1% to 5.9%. And this is because we have seen evidence of softening in consumption growth. But consumption is still growing, and India's economy is still performing well, in our view, against the overall background that Daniel just gave you on the global economy. For the next fiscal year, we have projected the growth, we have reduced it from 6.8% to 6.3%. It's 0.5 percentage points reduction, but this is mostly against the new data that has become available on the pandemic years and on fiscal year 21-22, where we have seen much stronger than we had initially estimated growth. So this so-called revenge, consumption has happened much more strongly in the previous years, and the catch-up towards potential had already happened. And so we do not expect any catch-up or a little bit less catch-up for the next fiscal years. This explains our reductions. I think we still overall think that India's economy is performing well against the global economy.
Well, that's an important clarification that, this is on the back of revised data from the pandemic years, which shows stronger than expected growth. But Nada, what are the risks to this outlook that you've outlined for India and the assumptions that you've made for the best and worst case scenarios?
Well, we see risks mostly coming from the outside. and the outside, the external risk are really tilted to the downside. We see risk in the volatile and uncertain global financial environment. And if those risks materialize, we would see a sharp reduction in capital flows globally and capital inflows to India. We also see risks coming from increased geopolitical tensions and also risks from increased global fragmentation. So if you put all these together, and if these risks materialize jointly, we could see potentially quite a severe impact on the global economy, on emerging markets, and including on India.
I see. Daniel, the IMF has also said that a hard landing, especially for advanced economies, is now a much more pronounced risk. What are the chances of recession in these economies as per your current projections, and what will this mean when it comes to trade-offs for policymakers, especially in the advanced economies?
Ritu, yes, advanced economies are the group with the sharpest slowdown this year, from 2.7 to 1.3%. That's a halving of growth for them. And that's going to mean also higher unemployment. Euro area growing at 0.8%, US at 1.6%, a number of countries even with negative growth. Already in recession. This is really a reflection of the tighter financial conditions, higher borrowing costs as the central banks really fight inflation there. There is also a risk that inflation is even stickier and more stubborn than we expect. And if that happens, we may see interest rates higher even for longer. That would be one of the main downside risks.
Well, Daniel, just to take that forward, given that inflation is sticky, and if it remains so, like you said, global central banks will have to continue their tightening. What would that mean for emerging market and developing economies? Is there a larger risk of, capital outflows, and what are the measures that can be taken to mitigate these?
Unfortunately, when there's a slowdown in advanced economies, it does have a spillover, less demand for goods and services from emerging market and developing economies. It also pulls down the price of oil for the producers of oil. That pulls down their growth. The issue about the fight with inflation is that it's also involved a dollar appreciation because the Fed has raised interest rates relatively quickly. And that means depreciation for currencies in the emerging countries. It means higher inflation, imported inflation, and potentially some financial destabilization when there are foreign currency debts. So to face these challenges, our general perspective is that if exchange rates are being moved by fundamental drivers like the Federal Reserve increasing interest rates, it's going to be very hard to intervene against that. And foreign exchange intervention should be really reserved for cases where this creates a financial crisis because of, for example, dollar-denominated debts in those countries, or when it really puts in jeopardy inflation stability. So that would be on foreign exchange intervention. In an imminent crisis situation, we also see as appropriate to consider some capital controls, but this is really something that shouldn't substitute the more traditional getting the macro policies in the right order.
All right, Nada, in the context of what Daniel was just telling us about sticky inflation and sort of the reaction from countries, what do you make of India's central bank's own actions? For instance, in the April policy, we saw the Reserve Bank of India pause on the rate hikes because it wanted to see the effects of the past few hikes. Can the economy really sustain, further rate increases? And what should be the ideal policy response in a scenario, where Daniel is talking about imported inflation? It remains stubbornly high for a country like India, and growth is not really on a firm footing just yet.
Well, Ritu, as you said, we have seen that the Monetary Policy Committee in the April 6th meeting decided to pause. This comes after 6 successive interest rate increases over the past year. The cumulative increase was 250 basis points, and today the repo rate is at 6.5%. This pause, in our view, was warranted because although inflation has been high above the tolerance band, we see it declining in the next few months. We see the shocks from commodity prices and food prices declining, and we also see that there is now room, there will be room for all the policy rate increases of the past months to start producing an effect, and so the pressure on core inflation to also decline. So in our projections, we see average inflation over this fiscal year ending at slightly under 5%, 4.9% for the year. So over the course of the year, the current stance that we see from the Monetary Policy Committee and from the RBI is justified and well adjusted to the needs of the economy.
But, Daniel, do you think there's a risk of over-tightening by central banks and therefore derailing this rather fragile global economic recovery that is even starting to take shape?
Well, the priority really is to bring inflation down because this is the necessary condition for stability and growth and investment. So our perspective is that central banks should be steady in their anti-inflation fight, but ready, steady but ready to adjust if necessary, if there's a sharper adjustment in financial markets, if there's banking stress. They've shown so far that they can really do the two at the same time, deal with stresses when as needed and keep the focus on inflation. But if there were a much more severe situation with really a credit crunch, now this is not at all what we think is the baseline, but if that were to happen, then there would be a case to reconsider the pace of rate hikes and in fact, potentially reduce them. But this would have to be accompanied by a very clear communication that nevertheless, after this passes, we will resume the inflation fight and bring inflation down under control.
All right. Unfortunately, we've run out of time, but Daniel and Nada, both of you, thank you very much for taking time out for CNBC-TV18 and explaining the repercussions of what you project to be a weak global economic outlook. Thank you very much for your time here. All right, it's time now for us to